Universities in the US are known for being at the top of academic rankings. That's one big reason why the US is still the most innovative country in the world. University research serves as the cornerstone for major technological giants that dominate the global market. On average, students end up with about $37,718 in federal loan debt, and if you add private loans, it can go up to $40,499. That's more than the GDP of many countries. So, is pursuing higher education feasible? What alternatives do we have? In this video, we explore and provide insights into these questions. The United States is considered the global leader in higher education, home to some of the most prestigious and internationally recognized universities. Institutions like Harvard, MIT, and Stanford consistently rank among the top in the world, known for their academic excellence and contributions to research. And for many young Americans, attending college opens the door to greater job and economic opportunities. Obtaining a higher education degree is traditionally seen as the key to building a promising future. That's why entire generations of families have made significant sacrifices to ensure their children can pursue a college education. However, the rising cost of tertiary education challenges this American dream for many. Like other developed countries, the United States has made college almost a mandatory stage in the lives of the younger generation. Due to this widespread belief, pursuing a bachelor's degree has become more than a personal goal for many. It is also a familial and societal expectation. Unlike in some other countries, in the US, students and their families are the ones who have to pay most of the costs. According to the Federal Reserve, almost 1 out of every 3 American adults has taken out loans to pay for college. The total amount of all these student loans is a massive $1.77 trillion. But have you ever wondered why so many Americans find themselves burdened by student debts that linger for years? The answer lies in a concerning trend: the skyrocketing and uncontrolled increase in the cost of attending college. To better understand the reasons behind this, it's essential to examine alarming statistics on how the costs of attending college have been consistently rising over the years. According to gathered data, the total average cost of attending college, including tuition, books, supplies, and daily living expenses, has now surpassed $36,000 per student per year. This amount doesn't even cover other potential expenses like transportation or housing. The most concerning aspect is examining the speed at which university costs have grown in recent decades. It has been reported that since 2000, the average national tuition has more than doubled, with a continuous 2% annual increase in the last decade alone. Simply attending a public university in the state costs, on average, over $26,000 per year, covering tuition and other expenses. If we talk about a private institution like Harvard or Yale, this figure increases
to $55,840 per academic year, and only $38,768 of that amount
goes toward tuition and fees. Data also indicates that both public and private universities have significantly increased their costs over the last 20 years, even after adjusting for inflation. With this tough economic reality for affording college, many young people have to check out different ways to pay for it. Saving up for college and applying for scholarships and grants can help a lot in paying the bill. Still, even with good savings and a lot of financial aid, many families will need to take out student loans to cover the cost of college. In the US, there are basically 2 types of loans you can get: federal loans and private loans. As you might guess, private loans are offered by banks or other private financial institutions, which independently set interest rates and other credit conditions. This flexibility can translate into higher available amounts, but usually at higher costs. In other words, you could be at risk of accumulating excessive debt. On the other hand, federal loans make up the overwhelming majority, accounting for 92% of student loans. Within this category, we have 2 main subtypes: subsidized and unsubsidized. Both come with lower interest rates set by federal law, as well as debt forgiveness programs and income-driven repayment plans. However, they do have differences that we'll explain to you. The subsidized loan from the direct loan program, also known as Stafford or direct loans, is usually the first choice for borrowing money to cover college costs. Unlike other loans, these are based on the student's financial need rather than credit history, so no credit check is required. The university determines the maximum eligible amount based on the student's budget. It's important to note that these loans are only available for undergraduate students. Another significant advantage is that the federal government covers the interest payments while the student is enrolled at least half-time, preventing the balance from increasing with accrued interest during the years of study. There are limits on how much each student can borrow each year, but sometimes you might need more money. That's when other options like unsubsidized loans come into play. First, one of the main differences between these two types of federal loans is their eligibility. While subsidized loans focus on financial need, direct unsubsidized loans are available to any student, regardless of their income, for both undergraduate and graduate studies. However, just like subsidized loans, the university decides the maximum amount you can borrow based on the tuition cost and other aid. The key difference lies in the fact that the government doesn't cover the interest on unsubsidized loans while the student is in school, so interest starts accruing from the disbursement date. Any accumulated interest gets added to the total loan amount once studies are completed. So, let's say your loan started at $10,000 and you racked up $1,000 in interest while in school. Your loan's not $10,000 anymore. It's $11,000. Now, $1,000 more on a single loan might not seem huge, but across the US, student debt is a massive crisis. Even starting with a lower amount could end up costing thousands extra over the loan's life. Recent data shows that the total student debt has reached a staggering $1.766 trillion. More than 93% of that is from federal loans, with an average of $37,718 per person owing money. There are 43.6 million borrowers carrying this debt, and even though default rates have dropped, the average borrowed just to get a bachelor's degree is sky high.
Around $32,637 in public schools. And on top of that, the yearly interest they have to pay is about $2,186.
That means the typical student borrower will spend a solid 20 years paying off their loans, really working hard to do it. At this pace, the famous American dream might become out of reach for future generations, only for those who can afford to pay for college up front. These figures highlight the enormous challenge faced by millions of American families, whether during their studies or after graduation, when trying to meet their credit obligations. Nevertheless, students are always told that college is the best path to a financially secure career. However, after witnessing the rising cost of education, the mountains of student loan debts, and the challenges of securing a job in the field, many graduates have felt disillusioned and deceived. Is college worth it? A recent survey by Tsengege, a place that offers educational courses, found that almost 8 out of 10 students think their education is worth the high cost. But they say it's only worth it if their degree quickly leads to a job, financial freedom, and if they can pay off their student loans in 10 years. Sadly, meeting these requirements is tough. Once upon a time, having a college degree meant you'd make a lot more money compared to those who didn't go to college. But things have changed. Recessions, lots of students going to college, and not enough jobs have not only made salaries lower, but also made the purchasing power not as good as it used to be a few decades ago. What's more, over half of college grads are either jobless or working in jobs that don't need a degree. It's not looking too promising. Then there's the time factor. A study by the National Center for Education Statistics says only half of the students who start at a 4-year school actually have a degree 6 years later. And these numbers could go up even more for folks with limited money or students from groups and families who usually haven't gone to college, but spending more time in school means more expenses, and in many cases it leads to more debts and fewer chances to save up. The longer it takes to start making money and saving, the tougher it gets to keep up with bills. Here, students are already at a disadvantage right from the beginning. Most 4-year and 2-year students are handling their college costs on their own, without family help, and it's a struggle. After paying for school, almost half of them have $250 or less left each month. That money goes straight to buying food and covering basic living costs, leaving little or no room for saving. What's worse, some might have to borrow more just to make it through the month. That's why, for many young Americans, dealing with a big student debt becomes a major factor in their life choices, especially when they're trying to be independent and start new chapters after finishing their studies. With monthly payments that can go over hundreds of dollars, managing other short-term money needs becomes really tough. 2 key goals that get postponed are buying a home and family planning. With so much money tied up in paying off debts, most can't save up the down payment needed to qualify for a mortgage, allowing them to escape the high costs of renting. And how could it be different when, in fact, student debt is the second major cause of indebtedness for American families right after mortgages? Similarly, taking on the significant financial responsibility of starting a family with kids becomes nearly impossible while they're tied down by monthly payments. Added to this is the limited ability to take risks in personal ventures when incomes are affected by years of monthly debts. It turns into a vicious cycle, making it hard to move forward with goals typically associated with youth. With all this, we also see that student debt not only takes a physical toll, but a mental one as well. Student Loan Planner, a financial advisory company, found in a survey that 9 out of 10 borrowers experienced significant anxiety due to the burden of their loans. What's more, a mental health survey in 2021 indicated that 1 in 14 borrowers had suicidal thoughts in response to the financial stress of student loans. Among borrowers who were unemployed or earned less than $50,000 annually, this rate jumped to 1 in 8. Unfortunately, this kind of stress can't be eased with therapy alone. Real alternatives are needed to genuinely bring relief to the situation. Of course, you can always go for scholarships or spend a few years at a community college to get the university credits you need for the first 2 years at a lower cost than a full 4-year university program. But when thinking about your professional future, it's not always necessary to pursue a traditional 4-year college degree. Today, there are multiple shorter and more accessible educational options for those who want technical training without pursuing a degree. An interesting alternative is trade or technical schools. In comparison to college, the focus here is on developing a specific skill in a shorter time. Think of careers like electrician, plumbing, nursing, or professional cooking. These are more practical trainings aimed at quickly entering the workforce once certified. Another advantage is their lower cost compared to a degree program. Then there are the highly popular apprenticeship programs. Here you combine on-the-job training with classroom instruction. Many are paid so you can earn money while studying. There are thousands of options covering areas like mechanics and more. The best part is that these careers often last between 1 to 6 years. Also, coding bootcamps are like crash courses that teach you the basics of building websites or mobile apps in just a few months. You don't need a fancy degree. They give you practical tools to jump into the IT job scene. And guess what? They cost way less than a 4-year computer science degree. These are just a few options. But undoubtedly, technology will play a crucial role in democratizing access to knowledge. New tools emerge every day that bring education closer, regardless of where we are. At the same time, the job market is evolving rapidly. With the rise of digitalization, there is a demand for new skills that can be learned more specifically and practically. In the future, specialized technical training, whether in person, online, or hybrid, might open as many doors as a traditional 4-year bachelor's degree. In this changing world, what will matter most is picking up practical skills rather than just chasing after a degree. Education will be more open, flexible, and shaped around what today's world needs. And fingers crossed, dealing with heavy student debt might become a thing of the past.